Good day, everyone. My name is Dan of Sharpe Trade LLC, and this video is continuing in our series of videos regarding money management for investing and trading, which is really the topic of just mathematically, how do you stay profitable over a series of trades or over a series of investments, And please remember that this is a series that we have. You can either follow along on sharpetrade.com itself, the main website of Sharpe Trade LLC, so you can follow along on the main website, just article by article, and each article will link to the next article. Or if you go to our YouTube channel, Sharpe Trade's YouTube channel, and if you scroll down to the playlists, you'll see there's an entire playlist on money management for investing and trading. Now, to date in this playlist, we've sort of discussed the main principles. There's like 6 main principles of just the math of managing trades, of drawdown, of accuracy. Accuracy is not the end-all, be-all of trading. So we've discussed those 6 main principles. However, there are other principles, and that's one of which I want to talk about today. And it also touches on somewhat of an interesting phenomenon that I have noticed. Now, we reach out to, and our sort of target audience is new self-directed retail traders. So what does that mean? That means folks that are going it alone at home. They want to save some money on expense of having somebody else do it. They want to understand how it works. So that's sort of the folks that we're reaching out to. They're just, at home, want to be at-home traders. Now, in talking with some of those folks, the phenomenon I'm talking about, it's fascinating to me, and I don't really understand where it comes from. But many times, many of us at the company will be talking with somebody, and we say, well, in the industry, this is pretty accepted practice, and it has there's a lot of good reasons as to why everybody in the industry of finance takes this particular course of action. And I've seen this myself. I know other guys at Sharpe Trade have seen this 5 or 6 times in the last month. Is that people will say, well, that's all good for professionals, but I'm just an at-home trader. Huh? That doesn't seem to make much sense to me. If everybody in the industry is doing it, and there's a lot of logic behind it, there's decades of proven experience as to why that works, there's mathematics behind it, why would you not do the same thing that professionals managing large portfolios do? That doesn't make sense. And I don't care, well, I'm not just talking about hedge funds. For some reason, new self-directed retail traders or retail traders seem to think that all professional money, if you're talking about the world of professionals, then you're talking about hedge fund money. No, it's not. No, it's not. Sharpe Trade is not a hedge fund. So I don't really understand that thought process that, well, first of all, well, that's all good for professionals who you're going off of years of proven mathematics and how to achieve risk-adjusted returns and manage portfolios worth millions. But I'm not a hedge fund. I'm just a stay-at-home trader. Well, it's like, first of all, why wouldn't you do what folks would? Why wouldn't you engage in behavior that there's so much proven history behind that it works? That doesn't make any sense. And second of all, not all professional money is hedge funds. Hedge funds is a small part of professionally managed money. So that always confuses me. Now, that ties to the topic that we want to talk about when it comes to money management. If you are a new retail trader starting out, this does relate to the math of remaining profitable. Add capital regularly to your account. I cannot stress that enough. And since Sharpe Trade reaches out to new self-directed retail traders, we're not going to look down on anyone because of account size. That's silly. It would be arrogant to do so. Whatever your account size is what your account size is. Okay? But add capital to that account. And we don't care how much capital it is. Whatever it is, it should be disposable. It should be funds that you can use for investing and trading. Well, that goes back to our How to Begin series. Our very first article in the How to Begin series for investing and trading talks about Dave Ramsey's baby steps. So that should be the first thing. So, you should have disposable income for investing and trading. This isn't money that you need, for groceries or anything. That being said, add capital to your trading account regularly. I would say every week. Whatever it is, it should be disposable. Right? You should be in that stage. We just mentioned that. And whatever it is whatever it is. We're not here to pass judgment on anybody. I don't care. I've taught people what it is that I do and shown them what I do for years now. I don't care if it's $5. I don't care if it's $10. For the Sharpe Income Project, we do this. It's $25 every week. When I first started out trading, and I got my head on straight with money management principles, it was $35 a week. I've shown people what it is that I do, and they could contribute $50 a week. To them, that was disposable funds. I've taught people that can contribute $100 a week. I've mentored folks that could do $175 a week. That was completely disposable income to them. I don't care what the amount is. I don't care. Whatever it is, it should be deposited every single week. You can go into many brokerage platforms, set up an automatic deposit every Friday, bam, that much money goes into your trading account. I don't care what the amount is, but there should be regular capital contributions. Now, this ties back to what we mentioned at the beginning of this video. This is what everybody in the industry does. If it's a private company, and this company has traders, private equity, whatever, however the structure is set up, closed fund, whatever it is, it generally unless you're over like $600,000, $700,000, $800,000. We're talking to new self-directed retail traders. Under that amount, those managers, those portfolio managers, are all interested in getting more funds. What does a hedge fund do? It looks for other investors, more capital. Everybody does this. So that ties back to the principles that we mentioned in the beginning of this video. We see that new self-directed retail traders typically are not doing this. They're not making regular capital contributions to their account. Now, you cannot count that capital as part of your gains. So whenever you're calculating your returns or your performance, you have to back out what you've contributed, right? That doesn't count towards how much you're up or down for the year. Then Dan, why add capital? Because it adds flexibility to what you're doing. If capital's always coming in, it means that everything is more flexible. I mean, and just look at it from the standpoint of the contrast of what a retail trader typically does. Here, sometimes I like to go over to like a paint program and use it sort of like a whiteboard. Let me show you what we find that a lot of retail traders do.
Let's take an account here. Let me see, how can we do this? We're going to take an account, history. So we will call this portion right over here, we'll call that, just sort of the start of the account. So there we go. You're all excited. You got the account starting off, and obviously this horizontal line here, that'll just be the percentile performance of the account. There we go. So they're all excited, and they start off trading. They don't pay a lot of attention to risk control and risk mitigation. So you know what sometimes can happen is they'll have an explosive, here, let's color that one green. They'll have an explosively great trade. Look at me, IR great trader, right? So they'll have this wonderful trade, and they're up a bunch. Great, fantastic, great. But it's only, maybe one, maybe two trades. Now, what they are not doing is this entire time down here, they are not contributing capital to their account. They're taking on too much risk according to the money management principles that we mentioned earlier in this series. They're taking too much risk for their account size. So what typically happens right around to this point is they'll have a big loss and they'll think, well, that stinks. Let's fill that in. And they think, well, let me go out and find another great trade. And again, because they ignore the money management principles that we talked about earlier on in this particular series, they have another big loss. And it may be 2 wins, 3 wins, but it's just the mathematical risk of ruin, right? Eventually, this catches up with them because they're just taking on too much risk, and they have another big loss, and they're down here. Now, right about at this stage, right about here, is where they say, gee, I need to maybe add some capital to the account. And so what will happen is they'll add some capital to the account, and then they start trading again. And let's just say they don't have a loss. Let's say they have another win, right? And then they have another win. Maybe they even have another small win. That's typically what happens is the wins start becoming smaller. But again, they're ignoring the other money management principles, and the same thing happens. They have a loss. Let's fill these in. So what you see happen to the account. Now this entire time, as we had said before, what we see again and again is they are not adding capital during this portion, and they're not adding capital during here. So what typically ends up happening is what typically ends up happening. They start taking on too much risk, and they say, well, crud. My account's back down. So obviously what I have to do at this point is I have to go out and find some capital, because it's just this cycle of behavior. And they say, okay, I'm gonna find some capital and add it right here. And then the whole cycle starts over and over again, and they're looking to be correct on 1, 2, 3, 4 trades. We've already discussed in this series that really doesn't matter, right? What matters is your money management, taking on risk appropriate to your account. How accurate are you? When you do lose, how much do you lose? So this is typically what we see with new retail behavior. So let's back this up and let's start all over, shall we? Let's put that back. Only this time we're going to add capital regularly to the account. So let's signify that somehow. Let's call it a little plus sign, a green plus sign for adding some capital regularly to the account. And that's going to be done regularly every single week. There we go. So that just signifies capital being added to the account each and every week. So instantaneously, you got a little bit more flexibility here. Do you see that? I mean, just through the life of the account, your capital is going to be added. Now, you can't count that towards the capital performance of the account. We already said that, but we're just going to illustrate it that's that capital being added. So now, what will happen is a new trader will start off, and he does pay attention to money management principles. And let's say he starts off with a loss. Uh-oh. So he comes down here. Well, that sort of stinks. But he's got some capital. Provides a little bit of, of psychological boost. But that's not the real reason why. So let's say he has a win. Comes down here. Okay, great. A win. And he's taking on risk. Let's call that, let's call that 2 wins. So he has 2 wins. Fantastic. But he's always taking on risk, according to the principles that we've already talked about in this series, appropriate to his account size. So now he has a loss, but he has an appropriately sized loss. Looks a little bit different, doesn't it? And oh, by the way, he also has all of this capital that he's contributed. So now the account's up a little more, and he has more flexibility. So in this, just illustrating it through this sort of very rough hand, manner, do you see the flexibility this provides? It avoids the risk of ruin because at no point does this trader say, well, crap, I've got to go out and find a bunch of money to put back in my account? It's already there. And he'll have a loss. And he'll have another loss. And he'll have another loss. Maybe he's making his losses less on each successive trade. There's a way to do that with money management, to where when you have more than your normal consecutive losses, you make the third loss, you make the whole position size even smaller. You shrink your position size. So this guy right here, he's thinking about his risk. And oh, look at that, there's more capital. So that, let's say he wants to make an investment. Well, I've got the capital to do it. I don't have to run out and find an investment. And this is not some state secret. I'm just drawing this out in this very rough manner. This is what everybody does. Doesn't matter if they're a hedge fund, private companies, public companies hire traders to trade some funds, to make some maneuvers according to the mandate of the company. Right? That's not a hedge fund. Well, the company has revenues. So, there's always capital being contributed. They back that out when they take a look at the performance. But do you see how all of these capital contributions mean you're just that much more flexible when you're going to look for trades in which you're controlling your risk? You don't have those massive, blow-ups. You don't, let's back all this out. You're not doing this. Actually, we got to back all of that out because they're not doing that. They're just not having these massive blow-ups, massive down things. Oh, you know what? Now is when I maybe should go out and look for some capital. It bypasses all of that behavior. Add capital regularly to the account. And trust me, it's going to, even though you don't count it for your performance, it means that everything's more flexible, even after some losing trades. More than just psychologically, I don't know what to do. Let's say it's a longer-term buy and hold, like our Mastering Markets Valuation course. Well, if you suffer some drawdown, and then you get to the end of that drawdown, right? Let's say it's 7%. Well, when the account begins to recover, you've got more capital. What happens if you want to make another long-term valuation buy? Oh, gee, look at that. There's capital in the account. Add capital regularly to the account.
So once again, as just a point of money management, tie this entry up. Make regular capital contributions of disposable income to your trading account. Doesn't matter what it is. Doesn't matter if I don't care if it's $5, $10 a week, 25, 35, 50, 100, 150, whatever is disposable, whatever you can afford in as disposable income that can be put towards, or capital that can be put towards investing and trading. But it has to be there because the flexibility that it opens up, you don't get into the hole that so many retail traders do and have the mathematical risk of ruin because you wait until it's too late to say, oh, whoa, gee, now I need flexibility. Now, we don't do this for the Sharpe report, right? The Sharpe report's just one lump sum. Why is that, Dan? If you're saying this is a good idea, why don't you add capital? Because if you added capital, like even $15 a week, that teaching account would be much, much higher than it is now. I'm gonna level with you. It's a little bit honest to charge people, showing them what it is that I know and how the moves that I'm making. That's all I can do. I can just show you the moves that I'm making and the why and the where-tos and the wherefores behind the decision-making process. And then say, oh yeah, not only are we charging, but add $50 a week on top of that. So we just felt as we set up the products that we did for the Sharpe report, it makes sense to just show the skill. I can do it with lump sum. I've proven that. Boy, the last half of 2015 is sure shaping up a lot better. Yeah, I'm looking at the market now. A lot better than the first half of 2015. However, it's showing the decision-making processes and the skill. And then once somebody has that skill, then they can, okay, yeah, now I'm adding capital contributions, right? So we just figured for the Sharpe report product, it would just make more sense to just illustrate the skill behind it. But seriously, backing that out of it, and so that's why we do the Sharpe report that way. But backing that out of it, seriously, add capital each week to your account. Don't care what it is. gives you a tremendous amount of flexibility, and this is what everybody else in the industry is doing. So why wouldn't you do it? Where's the logic in that? All right, so that concludes this entry in our money management series, and of course that has been what it's always been. It's simply been our thoughts, not yours. For whatever the heck day it is, as always, stay safe, trade well, and remember that love doesn't cost a dime.